Today we're digging into some really insightful material from John Bogle's little book of common sense investing.
Yeah, it's classic stuff. Our mission here is basically to pull out the key ideas, maybe some surprising bits, and give you a shortcut to understanding this whole common sense approach.
Exactly, because the core message is, well, it's simple. Successful investing is simple.
But not easy. That's the catch, right?
That's the catch. And a huge part of the not easy is something we often just gloss over. Costs, fees, expenses,
They add up. So let's dive in. What's the big, simple idea from these sources? The winning strategy for stocks.
It's surprisingly straightforward. You just own all the publicly held businesses, everything.
All of them?
All of them. And this is key. You do it at a very low cost.
Okay, own everything. Why does that work? Why is that the winning move?
Well, think about it. If you own a tiny piece of every company, you are guaranteed, essentially, to get the return that the businesses themselves generate.
You mean like dividends and earnings growth?
Exactly. All of it. The dividends they pay out, plus the value they create by reinvesting their profits and growing. You capture the whole thing.
So you're basically just hitching your wagon to the entire economy.
Pretty much. And the sources show this amazing correlation. Like, since 1929, U.S. GDP growth. What was it?
6.2% nominal annual rate.
Right, 6.2%. And corporate profits over the same time.
6.3% annually. Almost identical.
Yeah, the correlation is like 0.98. Businesses, as a whole group, they just grow with the economy. Owning them all means you ride that wave.
Simple. Makes sense. But then the costs creep in. This is where it gets tricky.
This is where the relentless rules of humble arithmetic, as Bogle puts it, come into play. Costs just chip away at that return.
They really do. Year after year, tiny percentages feel like nothing, but over, decades, it's a massive difference.
He uses this great little story, this parable about the Gottrocks family to illustrate it.
Oh, yeah, the Gottrocks. It's perfect. So imagine this family, the Gottrocks. They initially own all the businesses directly, no middlemen. So they get 100% of the pie, right? Yeah. All the dividends, all the reinvested earnings.
Sounds ideal.
It is. But then along come the helpers, brokers. They convince some family members, hey, you should trade stocks with each other. And boom, commissions start eating into the pie. The family share shrinks.
And trading means taxes, right? Another helper gets a slice.
Exactly. Capital gains taxes take another bite. Then the Gottrocks think, well, we're not great stock pickers, so they hire experts, money managers, more helpers.
And more fees.
More fees. And these managers, maybe they feel pressure to do something, so they trade more often, which means
more commissions for the brokers, more taxes.
Yeah.
The pie just keeps getting smaller.
Smaller and smaller. And it doesn't stop. They then hire consultants, helpers again, to help them pick the manager.
Seriously. Another layer.
Another layer of cost. So by the end, that original 100% pie the businesses generated, the family's actual take-home slice is way, way less.
That really paints a picture. And the actual numbers in the material, they're pretty stark.
Yeah, like the example, market returns 7% a year. Seems decent. But if you pay just 2% in costs each year,
your net return drops to 5%. That 2% difference doesn't sound huge, maybe, but over 50 years.
It's the difference between retiring comfortably and, well, not.
And the real-world data backs this up. The sources mention a 25-year period where the average active fund returned, 7.8%?
Yep, 7.8%. But the S&P 500 index fund, over the exact same time,
9.0%. That's a 1.2 percentage point gap every single year.
Compounded over 25 years. That's enormous. And that's before taxes.
Right. Active funds trade more, generate more taxes. The material estimated something like a 1.2% effective federal tax hit per year for taxable investors in active funds around mid-2017.
Ouch, wiping out even more of their return.
Meanwhile, index fund investors, because the funds barely trade, they paid way less tax, maybe around 0.45%, even though their pre-tax return was higher.
Lower costs and better tax efficiency. The arithmetic is just brutal for high-cost strategies.
Okay, so the path seems clear. Own everything, keep costs super low. How do you do that?
Well, this is where the traditional index fund, the TIF, comes in. It's the practical tool.
Right, the fund that just tried to mirror a big market index, like the S&P 500.
Exactly. The S&P 500 tracks, the 500 biggest U.S. companies, about 85% of the market value. Or you could use a total stock market index, covers even more.
And do they perform much differently?
Barely. The material says their returns are correlated at 0.99. They move almost in lockstep. So tracking the S&P 500 gets you pretty much the whole U.S. market experience.
And the beauty of the index fund, according to the sources, is its structure.
Yeah. It's super diversified, expenses are minimal, no built-in advisory fees, portfolio turnover is tiny, meaning less trading, less taxes.
High tax efficiency. It all connects.
It does, and the result, well, there's that anecdote about the first index fund, the Vanguard 500, started back in '76.
Oh yeah, the lawyer who invested.
That's the one, put in $15,000 at the start. By 2016, 40 years later,
How much was it?
over $913,000.
Wow. Just from holding and reinvesting, that's the power of letting the market work for you without costs dragging it down.
Precisely. Now, the book is careful that was a period of unusually high returns, like 10.9% average for the S&P 500. We should expect lower returns going forward, but the principle remains the same.
And index funds stick around, right? Unlike active funds.
Exactly. The sources say active funds come and go. Like, of 360 funds from 1976, only 74 were left by 2016. They merge or close down after bad performance.
But the index fund?
It just keeps tracking the market. It goes on forever.
Let's shift gears a bit. Where do these market returns actually come from? The sources talk about a sort of dual nature.
Right. Bogle breaks it down. First, you've got investment return. This is the real stuff, the fundamentals.
Right.
Meaning the dividend yield you get when you buy, plus the growth in the company's earnings over time. It's tied to the actual business. From 1900 to 2016, this averaged about 9.0% a year, and it's relatively steady decade to decade.
Okay, so that's the engine. What's the other part?
The other part is speculative return. This has nothing to do with the business itself. It's purely about investor sentiment changing the price-to-earnings multiple, the PE ratio.
So like how much people are willing to pay for those earnings.
Exactly. Driven by emotion, greed, fear, hope. If PE ratios go up, you get a speculative boost. If they go down, it drags on your return. And this part, it swings wildly from decade to decade.
So investment return, steady business reality. Speculative return, volatile market mood swings.
You got it. And here's the kicker, the main point from the sources. Over the long run, almost all of your total return comes from that investment return, the business reality, the speculative return. It mostly cancels itself out over decades.
That sounds like Benjamin Graham's famous line.
It is. In the short run, the stock market is a voting machine. In the long run, it is a weighing machine. The voting is the emotion, the speculation. The weighing is the fundamental value, the investment return.
And the Mr. Market story fits here too, right? The manic partner offering crazy prices every day.
Perfect analogy. You don't have to play his emotional game. Focus on the underlying business weight. Because that long-term investment return tied to economics is somewhat predictable over long stretches. Short-term emotions. Impossible to forecast.
Okay, so if low costs are key and long-term returns come from business fundamentals, it really seems like trying to pick winning stocks or winning fund managers is just not the way to go for most people.
The data presented is pretty damning, honestly. Exhibit after exhibit shows the vast majority of active funds just don't beat their index benchmarks after cost.
That 85–90% failure rate mentioned for 2001–2016.
Yeah, across both stocks and bonds. The odds are heavily stacked against you pinning a long-term winner in advance.
And even if you find one that did well recently.
That's where reversion to the mean bites you. Past winners often become future losers. Remember that stat. Only 14% of five-star funds kept that rating a decade later. Top performers one period, often bottom dwellers the next. It's incredibly hard to separate luck from skill.
And it's not just the fund's costs or performance, it's also us, our behavior as investors.
Oh, absolutely. The dual penalties, the book calls them. Costs and investor behavior. We tend to chase performance buy high after a fund did well and then panic and sell low when things get scary.
So we sabotage ourselves.
We often do. That example is striking. The average fund returned 7.8%, the S&P 500 9.1%, but the average investor in those funds only got 6.3% over 25 years. That gap is the cost of fees plus bad timing.
Which brings us back to Buffett's quote from the book.
The greatest enemies of the equity investor are expenses and emotions. Nails it.
It's telling that even people like Charles Schwab, who profit from trading, apparently use index funds personally.
Right, and that point about needing decades or centuries to statistically prove manager's skill over luck, it just underscores how futile the manager-picking game often is.
Okay, so indexing looks like the common-sense approach for stocks. What about bonds? Or things like ETFs?
Same story, pretty much. For bond funds, that humble arithmetic still rules. Costs matter hugely. Active bond funds also tend to lag their indexes over time.
And with bonds, future returns are maybe a bit more predictable.
Generally, yes. The starting yield is a really good indicator of your likely return over the next decade or so, assuming you hold. The sources show it explains like 95% of bond returns historically. So again, a low-cost total bond market index fund is presented as the sensible choice.
Makes sense. What about ETFs? They're everywhere now.
Exchange-traded funds. Look, if it's a broad market index ETF and you buy it and hold it long-term for diversification at low cost, great. It's basically the same as an index mutual fund.
But
The ease of trading them minute by minute can tempt people into that bad behavior, trying to time the market, speculate.
letting emotions drive decisions again.
Exactly. The material mentioned that study of the best performing ETFs, investors in those ETFs lagged the ETF's own returns by like 5 percentage points a year on average.
Wow, just from jumping in and out at the wrong times.
Precisely. The low-cost vehicle didn't save them from high-cost behavior.
And then there are these smart beta ETFs. What's the verdict there from the sources?
Yeah. These claim to be better than simple market cap indexing, maybe by focusing on value or dividends or low volatility. They sound clever.
But do they deliver?
Well, the data shown in the material suggests, maybe not consistently, over a decade, things like fundamental index funds or dividend index funds often ended up with returns and risk levels very similar to the plain old S&P 500. High correlation.
So maybe just fancy packaging.
Often characterized as potentially higher-cost closet index funds. You're paying more for something that acts a lot like the basic index. Without reliable proof, it'll give you better risk-adjusted returns long-term. Humble arithmetic, again, higher costs need justification.
Okay, this can feel like a lot. What if you want help? Professional advice.
Good advice can help. The key, according to the material, is finding an advisor who gets this stuff, recommends low-cost index funds, and crucially is fee-only.
Remind us what fee only means.
It means they only get paid by you, the client, not by commissions from selling specific products. Their interests are aligned with yours. The sources suggest fee levels, like maybe 1% or less on assets under $1 million, scaling down from there. Robo-advisors often fit this mold too, using index funds.
Beyond the funds themselves, there's the big picture. Asset allocation. Stocks versus bonds. Any guidance there?
Yeah, it covers the basics, like Graham's ideas or Bogle's rule of thumb, maybe your age as a percentage in bonds.
Heard that one before.
It's common. But here's a really interesting twist the material brings up. Because costs matter so much, a lower risk portfolio, say fewer stocks, but with ultra low costs, could actually give you the same or even a better net return than a higher risk portfolio that's loaded with high fees.
Wow, that really highlights the power of cost cutting. It can let you take less risk for potentially the same outcome.
Exactly. The math works. Simple options mentioned are things like balanced index funds, maybe 60% stocks, 40% bonds. Vanguard's 60/40 fund had amazing results cited over 25 years. Or life strategy funds with fixed mixes.
And target date funds, TDFs. Good for retirement saving.
Potentially excellent, yeah. Super simple. They adjust the mix automatically over time. But you have to look under the hood.
Check the ingredients.
Check the costs and what's inside. You want TDFs built from low-cost index funds, not expensive active ones. The cost difference cited was huge, like 0.13% expense ratio for index TDFs versus 0.70% for active ones back then. That difference is massive over a lifetime of saving.
And one more thing on allocation, don't forget Social Security.
Crucial point. For most people, Social Security is like a big government-backed bond. You need to factor that guaranteed income stream into your overall retirement asset mix.
Looking forward, past returns were great, but the sources suggest dialing back expectations.
Definitely. Based on that humble arithmetic, lower starting dividend yields now, around 2% for stocks, 3% for bonds, mid-2017. Maybe slower growth ahead future returns are likely to be lower than that historical 9.5% average.
So the next few decades might not look like the last few.
Probably not. The sources mention projections from firms like AQR, GMO, forecasting much lower real returns, maybe low single digits for stocks after inflation, even less for bonds before costs. Again, long-term economics are more predictable than short-term emotions.
And if yields are low, how did you get income in retirement?
The suggestion is a total return approach. Don't just rely on dividends and interest. They might not be enough. You'll likely need to supplement that by selling off a portion of your capital each year.
Like the 4% rule.
Yeah, the 4% rule of thumb is mentioned, but with the important caveat that it's not a guarantee, especially if returns stay low.
Okay, let's try to wrap this all up. If we boil down this whole common sense philosophy from the sources, what are the key takeaways?
It comes down to a few core ideas, really. Diversify really broadly. Index funds are the easiest way. Keep your costs as low as humanly possible. Rebalance sometimes. Spend less, save more. Keep your expectations realistic. Ignore the daily market noise, the drama.
Focus on the long term.
Focus on the long-term business reality, the investment return, and maybe the hardest part, stay disciplined. Stick with your plan, especially when things get rough.
It sounds so sensible,
Yeah.
almost too simple, conspecting math and discipline.
It really does, like that quote attributed to Brandeis. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety.
And Paul Samuelson comparing the index fund to the wheel in the alphabet. That says a lot about its impact.
High praise, for sure. It changed the game for individual investors.
So we've walked through this common sense framework, owning the market, the tyranny of costs, the index fund solution, reality versus illusion, why active management usually fails, our own behavioral traps, other investments, allocation, future expectations.
It all circles back to keeping it simple and keeping costs down. That's the recurring theme.
Which leads to maybe a final thought for you listening. Given all this evidence from the sources, the cost drag, the active manager failure rate, our own behavioral pitfalls, the reliability of long-term business returns, does trying to beat the market actually make common sense for you anymore?
Yeah, what does that humble arithmetic tell you about how you're investing right now?